Welcome to this episode of the podcast. Before we get into it, I want to give you a special update from one of our sponsors, that's Term Plus. You've probably heard some of the team from Term Plus on the podcast before, but for the month of October 2025 until 31 October 2025 to be precise, Rask listeners who choose to invest their money with Term Plus can get a $300 bonus as part of an offer they're running for anyone that invests more than $30,000. Now, you know the drill. Always make sure the investment is right for you before investing, but you can follow the link in your podcast player or head to termplus.com.au to learn more about what's on offer and how to get involved. Now, let's get into the episode. Buy, hold, sell.
Oh,
Gaza Riviera? That's in the notes, Drew. What does that mean?
You remember this? You got to do it in the Trump accent.
This is the plan that Trump has.
Yeah,
right.
I don't know if this is back, but there was, I believe it was maybe 6 months ago when he first got involved in the Middle East conflict. Yep. Not involved, but trying to negotiate. He talked about turning the Gaza Strip into the Gaza Riviera, like the Italian Riviera. Hotels, beach clubs, all these kind of things.
Gotcha.
As a rebuild, but. Why it's relevant is if it's relevant, more so that there appears to be a peace deal between Israel and
Gaza.
Hamas, whatever proxy or whatever you want to call it. We don't try not to go too far into politics.
Yep.
Which he's claiming responsibility for as someone that got in the middle, tried to do the same in Ukraine, Russia. Mm-hmm. And why is it relevant? I have to keep asking myself this question. Mm-hmm. Well, and I think this will come up regularly, and you're incredibly good at it, so I'm going to be complimentary here.
Oh, Jesus.
You're amazing at it, to be honest. Which is
you must be so happy with that.
Which is
compliments.
No, it's about investing with optimism. So
optimism.
That thing. I reckon you would have seen me turn, and we counted that we've done 2 cents for 3 years.
Yes. Where's the cake at?
Yeah, I know.
Where's James O'Reilly with the cake?
But I reckon you've changed me too, because I was an internal pessimist, and I've gradually turned into not an eternal optimist. And you don't have to be. You can be a cynic. I talk to James O'Reilly. I'm like, have you always been a pessimist? He's like, actually, I'm a cynic. I'm cynical.
Okay. Yeah.
But having optimism. So I was like, well, we're worried about AI bubbles. We're worried about being able to execute. We're worried about war. We're worried about commodities. We're worried about crypto. We're worried about everything. But what if it all goes right? What if there's peace in the Middle East after whatever he's saying thousands of years, but after 2 years of this? Well, what if Ukraine, Russia come to some sort of agreement? What if the billions of data centers that need to be built are built? What if it all goes right?
Well, it could.
What are we sitting? I mean, and it's so easy for us to be negative all the time, but you're kind of seeing these little positive pieces of news. What if inflation doesn't kick off or return like it was expected to? What if interest rates actually fall again? All these what ifs, if they all turn positive, well, maybe this isn't a bubble.
Well, it all starts with a narrative, like Trump is giving us with the Riviera.
Yeah, positive.
Yeah, he's saying
sales.
This is what it could be. Yeah, we're going to transform this, because you look at the photos of Gaza, and it's just horrendous, right? It's, the whole situation is just horrendous. But then he comes in and says, well, we're going to make it like the Riviera, which for most people, even if you haven't been there, you can kind of picture this amazing,
beautiful,
affluent coastline that's like on the Mediterranean and whatever. Well, that's what he's putting that image in your head because he's trying to sell you on the optimistic take of it. Now, we don't have giddy optimism, but just some optimism is essential in investing, Drew. If you think about it.
If not, you just hold gold.
You just hold gold. Or you just don't hold anything. Like you would hold physical gold in your backyard.
Or baked beans and shotgun, as you talked about this week.
Yeah, in the email this weekend. If you don't already get the Rask email, it's every Sunday. You can head to any of the Rask websites and sign up. It's free.
It's one of my highlights, to be honest.
Really?
On Sunday night, yeah.
You read it, do you?
When I'm going to bed at 8 o'clock on a Sunday night, I always have a quick look at that.
See if you get a mention. As Drew said on the podcast this week.
Chart crime.
Yeah, it's interesting. Because I'm like one of these podcast listeners where I subscribe. So I listen to The Knowledge Project by Shane Parrish. Occasionally I listen to Tim Ferriss.
Yeah.
But I also subscribe to their emails, and I obviously occasionally listen to Equity Mates. I subscribe to that email. I subscribe to Motley Fool Rule Breakers, which is David Gardner's one. Actually don't subscribe to the email version. That is a bit hectic. But I'm actually one of these people that when I find someone that's like philosophically aligned, I will listen to the podcast, but also read it. I find it's two different things.
It feels more personal.
Yeah.
Like your email feels personal.
Well, thank you.
The way you write it.
Thanks. I try to be like, just talk about things that are interesting to me.
And conversational.
Most of the time, here's an inside baseball for everyone that's listening. If you do read the weekly newsletter, I actually often write that at like midnight on a Saturday night.
Yeah.
I feel like Barefoot Investor must be like planning his like a month in advance or something like this and doing it like real like clean. But like I can tell you behind the scenes, it's like Charlie's gone to sleep.
Yeah.
I'm in.
Is my
What's the best thing that we can talk about this week? Yeah. I love it. And it's good. I know you do like daily writing and that sort of stuff at Waddle. But I think that it's really good to get so much feedback on the newsletter because I do put a lot of effort into it. So today we're going to be I wanted to talk about a few things. We've got questions. You got a lot of stuff you want to bring to the table too. We're going to talk about WiseTech, Pro Medicus, and I want to do a quick little buy, hold, sell on Tesla because that is a company that's in your portfolio, been in the news a lot lately.
Indeed.
Just as a check-in on the portfolios for 2025. Remember, these are the $10,000 portfolios that Drew and I, the fake portfolios, not actual money in them, that we put together with the community portfolio as voted on by everyone that listens to the Australian Investors podcast. So the Dizzy Rascals community portfolio up 12%, just shy, it's 11.96. Big winner is Mader Group. Shout out to Matt Joss, who loves that company as well, or did.
And Vulcan.
ASML. What? How is Vulcan up 29%? It was down 29% like a month ago.
I don't know. I did a deal with a major... who was it?
They were running out of money.
Who was the provider?
They were about to run out of money. What happened?
Yeah.
What a dead cat bounce. Anyway, my portfolio is currently in second because Drew's has taken number one spot now. This is the best one is the name of the portfolio.
Did a deal with Glencore.
Oh yeah. RPM Global, which is one of my big winners in the portfolio, recommended at $3 according to this. They did come out with an update on their scheme of, I don't know what it was, but basically they're moving closer.
Doesn't look good.
No, it looks good.
Short it.
Get off my... If you shorted RPM Global, that would probably be like the biggest losing trade of the year because it's like virtually guaranteed to go through.
It's really only Home Depot and healthcare that are killing you.
Home Depot's down 3%.
What were you thinking?
So my big theory with Home Depot...
Have you been to a Home Depot?
This is where you... No.
Yeah, that's why.
This is where
West Farmers.
This is where you fall in love with the stock, right? Because I was like, I just love home improvement stores. Yeah. They're so optimistic.
Was cutting in last night. It was fun.
Oh, really?
Yeah.
The painting?
Yeah.
Oh, that's horrible.
Yeah, hence the paint on my...
Yeah, he's got... a few weeks ago, you had dirt under your fingernails, even though you drive a Prado. So
it's paint.
No, so I think that home improvement stores are pinnacle optimism. And as someone that's an optimist, it's always getting me because I'm like, if you've got enough money to do DIY on your home, things are pretty good.
Yeah.
One, you've got a home, unless you're patching something in your rental. And two, you know, you're investing in an asset and you're out and about doing this on a Saturday, getting the sausage on your way out, you know? Home Depot is the American equivalent of Bunnings. And I already had Bunnings in the Australian portfolio because I thought interest rates coming down, people spending way more money on snags at Bunnings. Which
$2.
Their Bunnings AI is pretty hopeless, let's be honest. But other than that, great business. So that's my portfolio. Drew's portfolio.
Happy to go deep on this one today.
Tesla. Yeah, why?
Tesla's the only thing that's lagging.
It's in the green now. Positive 1.5%.
What I found interesting, and maybe I can see the future. Who knows?
Yeah, well, probably. Most likely.
Is QRE is almost my top performer.
Which is the resources ETF.
Yeah, which is 34% BHP, which is only up 7%. But the other 65% of that is doing well. Mainly there's 20% gold miners in there.
Wait, how much is in BHP of QRE?
34%.
So QRE is the ETF, everyone, that invests in resources.
Yes.
So it's from BeachHouse, Australian Resources Sector ETF. Really, it's a fine ETF. If that's the exposure you want, it's probably the best one for it.
34% BHP, 8% Rio, 7% Woodside, Northern Star, Evolution, Linus. Good. But I think the key there is 20% is in gold alone, and that's clearly been driving this performance.
Interesting. I thought about something before when you were talking about the Gaza and Riviera, which is it's almost in some ways I feel like that's insulting to the situation. But,
very insulting.
But maybe people in the Middle East need that type of kind of motivation or some way. I don't know. But anyway, as you were saying that before, I was actually thinking while Trump was over there doing that, basically the same week, BHP came out and said that they're going to settle 30% of their iron ore in Chinese Yuan.
Yeah.
So for the first time ever, a gigantic global mining company is saying, yeah, we know the US dollar is the currency of the world. But by the way, China's open for business.
Yeah.
We sell our stuff to China. China needs iron ore. We're going to settle our money in Chinese Yuan.
And they're the biggest incremental buyer of iron ore.
You have steel in the world.
And they're in this impasse for the last few weeks, which had been, I think, holding back the share price too.
Well, that's why you and Mitch talked about this while I was away.
Yeah.
Is BHP was a bargaining chip.
Yeah.
Shout out to Trav from Money of Mine.
Yeah.
He did a deep dive on this on X, and he talked about how, like, in terms of changing, like, currency debasement, everyone's buying Bitcoin, right? Because they're like, the US dollar, blah, 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 blah.
Yeah.
But
Bitcoin and back
where do they go? They don't go to Bitcoin. No one gives a shit, really. You can speculate on that all you want. Where they're going to go, some of the world's going to go to the Chinese Yuan.
Yeah.
That's obvious.
Yeah.
And that has significant implications for how currencies and money and goods are traded throughout the world, and also security around the world. So big geopolitical thing going on this week. But
I found that interesting too, that crypto had its worst week in terms of market cap losses. I think it lost 19 billion Aussie this week after Trump came out and said he's going to apply 100% tariffs to China. Tweeted? Is it tweeting? Or what's his other platform? Truth Social.
When he's truthing.
Yeah, when he's truthing. I'm not sure. I mean, that's a good way to think. Everything you say is truth if you put on truth. I truth that. I hadn't thought about it that way.
I'll just re-truth that one.
But crypto fell something like 12%. Pretty much every major currency. Bitcoin fell 12%. Biggest losses. Again, headlines are like the biggest losses. It fell 10%. It's fallen 10% plenty of times before.
Yeah.
But the quantum, because the market is so big now, was like $19 billion. And I'm like, well, why was that the reaction to export, like basically a tariff, 100% tariff going on China? That was kind of the interesting part, that a tariff going on China was pulling people out of hedged assets. I thought it'd probably be the opposite.
Yeah, you'd think so.
Yeah. And a similar, I mean, gold had a little a blip as well, but then, returned the other way just as quickly as it fell.
All those people lining up at ABC Bullion in Sydney, I would love to just get just the zeitgeist of Martin Place. So if you haven't already seen the images,
buy the ETF.
Everyone in Sydney, there was this massive queues going into the gold bullion exchange in Sydney. ABC Bullion is the company. I think Mitch interviewed them on the podcast.
Did you have your trolley?
Cocktail
trolley? Wheelbarrow in?
Oh, swap all my Zimbabwean pesos for gold. No, I don't actually own any physical gold other than maybe the thing on my finger here, which is the cheap one compared to what the other half got. With the whole gold thing, it's just a momentum into geopolitics.
Yeah.
So we've seen that if we're speaking, we feel like this is the Australian wartime podcast, but over in Ukraine, Trump has also made strong signals together with Vladimir Zelensky about supplying more arms, together with, like you saw last week, if you don't know, the British did a joint NATO kind of patrol of basically the NATO border now. And that's happening more and more regularly to try and bring stability to the region there. And effectively all of those things are seen by gold bugs to be like positive, and which is bad for their asset. Yeah. So
and
how can you predict
gold
that?
bugs used to be quite niche. There weren't many.
Yeah.
When we bought, I covered it on the retirement podcast with James, which will be out in a few weeks. But it was, the gold bugs were niche and rare. And they blamed everything, or everything was why gold should increase. Rates up, good for gold. Rates down, good for gold.
Yeah.
Geopolitics, good for gold. Everything was good for gold. And it seems like the gold bug has spread, almost like a virus. And now you've got, big brokers predicting another 15% jump in gold from $4,000 an ounce. And it feels like a heavy momentum trade. We've held it for a long period of time and trimmed along the way, as you should if you've got an investment like that that's doing incredibly well.
You're right about that. Like, it's gone from probably like 5% of the population to 25% of the population, investor population owning gold.
I remember it never being talked about in the media. Like in the fin, you'd never hear about gold. And now every day there's gold.
We had Mark Jokum on from Global X, sponsor of the show. Global X, get around him. So we had Mark Jokum on the show, and he was talking about how central banks have been buying. Obviously, the jokers lining up at Martin Place to buy like a penny's worth of gold. Don't
Michelle
move the market.
Bullock wasn't there.
Yeah. The big ones are like the Central Bank of Poland being the biggest buyer of gold in the world. China. Like these countries buy gold because if their currency devalues, they can trade gold and buy armaments.
Yeah.
Is the gist of it. So that's what we saw in like parts of the NATO bloc. But who can predict that? Like who can stand out here and go like, oh yeah, there's like two schools of thought. There's one like the world is going to hell in a handbag, buy gold. And then the other one is, well, statistically, gold is not correlated to traditional asset classes.
But statistically, there's nothing you can find that is indirectly or directly correlated to. It changes correlation all the time.
Yeah, you could probably overlay the price of gold to the price of candles and be like, well,
buy candles.
Yeah, that's it. So like gold does have a place in portfolios. You own it. We own it. We have it no more than, off the top of my head, it's no more than, I'm going to check this live. I don't want to get this wrong for some of our clients, but
no more than 5% probably.
Yeah. What are you? How much do you hold?
But when we initially put it in, we were worried about debasement of current. We were worried about quantitative easing. We were worried about 0% interest rates. And we started it for some people at 7.5% to 10% of portfolios at the time because we didn't see you couldn't hold cash back then.
5%. We have no more than 5%.
Yeah. Most now are somewhere under 5% as well. Yeah. Sometimes at the top end, because you can imagine if you bought it at 1,600 an ounce, it's now 6,000 an ounce. It's increased significantly.
Yeah.
It's hard to be buying a lot of it in new holdings. If that makes sense. Like I think it still makes sense as a hedge, but not necessarily initiating that whole big position straight away.
But also, I was chatting to Rob Mead here. He was actually sitting in the seat that I'm sitting in right now. The podcast will be out soon.
From
PIMCO. Yeah. He's like the big dog of PIMCO. And he's been in markets. He's been at PIMCO alone since 2002, I think he said, or 2003. So he's seen the GFC. He's seen COVID. He's seen the European debt crisis. He's seen all these things like happening. China's property crisis, like all of these things. And I said to him, like, are you, like, where do you sit on like the spectrum of like where you're at like peak optimism for fixed income and bonds and that sort of stuff? And he's like, but probably the most optimistic I've ever been. Yeah. And he's like, if you think about it, and he cited a bit of research that, I don't know, have you ever heard of this? I haven't come across his actual research on this, but he said 95% of the return that you get from bonds comes from your initial starting yield.
Yeah.
Which makes sense because they're fixed income.
Yeah.
Like they're securities.
And they're diversified and they roll off.
Yeah, exactly.
If you're in an ETF in particular.
So he was like, the starting point is the most important. Yeah. And he said, your starting point at the moment for the securities that we were talking about yesterday, about 4.5% to 5%. And he's like, this is possibly like the lowest risk type of asset. And it's offering you 4.5% in upside.
You would call it the risk-free
yield.
Rate. US government bond.
Yeah.
Risk-free rate is what the comparison is.
So he's like, that's pretty good. Like pre-COVID, everyone was saying that bonds are dead. You get 1% yields.
Yeah.
Now, if you're a retiree, or even just me, if I had money and I'm like, what can I do with it? Well, 4.5% for lending to the government.
Fixed rate, lending to the government. And it's
better than a term deposit.
You can make the story that the government bankrupts or it's in a shutdown, but these things don't really matter when it comes to owning government bonds. The government bonds will be rolled or they'll be repurchased when the time comes.
And like you said, with an ETF, you can just sell it.
Yeah.
You don't have to hold the bond for 10 years.
The only risk of that is if interest rates unexpectedly go up.
Yeah.
And then something really bad happens.
But then I don't want to get too much. We've talked gold, bonds, wartime,
baked beans,
politics, shotgun got mentioned. If you go short duration bonds, that's such a jerk-face finance thing to say. But basically what that means, short duration, means that in bonds, you're going with shorter term bonds.
Like a variable rate mortgage, essentially.
Yeah, you go more to the variable side. That's why when we say short, we don't mean short as in like betting against the stock falling. We say short duration means like short term. Which means more like variable interest rates. If you're holding variable interest rate bonds, there's not that much risk of like bad news from a interest rate
and
change.
It's the thing about short duration bonds is that their interest rate's gone up as well because the risk-free rate's gone up. Yeah. So the income you're getting from that's even higher. Yeah. And we've invested into you call it a unlisted credit fund for like the last 5 years. Mm-hmm. The target return of that was something like 5 to 7%. And to get to 5.5 to 7% 3 years ago, they had to work so hard, find every little edge of opportunity. Now they're they're printing more like 9%.
Yeah.
And the 5 to 7% is just the income they're getting, and the active management is adding to the rest of it.
Yeah.
It's become easier to generate stronger returns. And that was, another question that came up in the ARP was, I had 10% in cash, 90% in shares. And James naturally answered going, you can get 4.5% in government bonds. And if the income you need is this, why are you taking more risk than you need to at the moment when things like government bonds are offering a really good base?
Yeah, absolutely.
We called it 2 years ago, didn't we? When we said it's the
we're
best time to invest I've ever seen.
Yeah. It probably was like 2 years ago. We said that for like the first quarter of the year, first 3 months. We're like, probably the best time ever to invest.
Cash
interest rates coming down. Stocks look cheap. Small caps have been hit. Bonds are looking good for the first time ever. Like, we didn't really go into gold, but we're like, you could pretty much buy anything. And property looked good. Yeah. Like, literally anything looked good.
We're all right.
Jeez. Come on, guys, get around us.
We didn't call it every time either. We didn't call it down every week. We didn't call it up every week.
Yeah. The one thing that I didn't act on, which you called earlier than me, was commercial property. Yeah. We now own the CLW REIT.
Yeah.
The Chatter Hall Long WALE REIT. You got that a lot sweeter than we did. What's that doing this year?
And Vicinity we had for a while too.
It's only up 13% this year. I don't even get out of bed for 13%.
And if you look at from that dip and the recovery once rates started falling off and normalization in the economy, do you feel rich?
Income. So Charter Hall's up 13%, but it would have paid at least 4% in yield, dividend. So 17%, that ain't bad.
It's trading at around NTA now.
Yeah, it is, yeah.
And we did get that wrong. There was a question that at $4.30, not, I think I said $5.80 or something for CLW on a previous episode.
We did a previous episode for everyone that's just tuning in, hasn't maybe been overseas for a bit.
Sometimes my Wi-Fi cuts out.
We both own the CLW REIT. CLW is a ticker symbol, Charter Hall Long WALE REIT. It owns like commercial properties, a lot of industrial properties, but the WALE part means that it's long-term leases. And obviously, if you don't own commercial properties, so maybe it's not obvious, when you invest in commercial property or when you take on a lease as a commercial client, like a business, you'll get your interest rate plus either a fixed increase or inflation adjusted. So like say you pay $10,000 a month or $10,000 a year in lease, it's adjusted by inflation every year. So effectively what happens is over the long term, the lease is insulated from inflation, which is a good thing for investors.
Yeah.
So what were you going to say? Something about rich?
So do you feel rich?
Why?
Household wealth in Australia increased 7.7% in the September quarter. The average household wealth per person, or the household wealth per person, is $654,000. Australians are the 5th richest in the world.
Is that the UBS thing?
Yes, UBS.
Yeah. Albo's doing his bit with the 5% deposit scheme.
Yeah.
It's propping us all up.
It's natural. Again, it's natural to be pessimistic and be like, oh, everything's so hard, cost like all these things. And yes, it is hard. I'm not pretending it's not hard for some people. But like all the data showing asset value, if you've got assets, asset values keep going up and property values keep going up. But I think we've talked in previous episodes, it's harder and harder to get from like lower class into middle or upper class than it's ever been. Yeah,
then that's the unfortunate reality of capitalism if you don't have a lot of bumper bars. It's hard. I firmly believe, if I take my optimistic hat here, Drew, I firmly believe that if you have the motivation in Australia, you can achieve basically anything.
Yeah.
Australia is the country on this planet that has set everyone up for the absolute best possible outcomes. And yes, it's not easy, but if it was easy, then everyone would be 6 billion, not 600,000.
Yeah.
So yes, I do feel wealthier. I think people generally feel wealthier, but the law of compounding dictates, Drew, and when you think about inequality, if you have $600,000 of wealth and the stock market goes up, all else being equal, you're $60,000 richer.
Yeah.
$60,000. If you've got $10,000 to your name and it goes up 10%,
you're 1,000.
You're 1,000.
Yeah.
So you're not getting ahead as quickly in dollar terms as someone else that already has assets.
Yeah.
But that's why we have a progressive tax system where people that have more money get taxed more. And if Alan Coller's right, over the next 20 years, we'll probably have an asset tax as well, where you have more wealth, you get taxed more.
And I mean, a big part of this has been surging super balances.
Yeah.
Because everyone's super balance has gone up. And then shortage of property, which is good for people that own property, obviously bad for people that don't own property, and that's where all the policy is looking at the moment.
Yeah, yeah. Do you feel rich?
No.
Yeah.
Yeah.
Need more. Give me more. Pro Medicus. I did do a bit of a tweet storm this morning. I think you can still call it a tweet. Maybe they call it an X.
A truth.
Well, this is on the anti-Trump. It's all Trump. Yeah. This is on the Elon Musk.
Anti-Trump.
This is on the Musk platform. So I did a Musk this morning.
That's.
But anyway,
yeah.
There's a lot of platforms these days. Everyone's got a social media platform.
Blooper to be that.
Yeah, the Waddle Partners social platform coming soon. So anyway, I was talking about how if I had $100,000 when I first bought Pro Medicus, today that would be worth $3.66 million.
Is this a chart crime?
No, that's legit.
All right.
I sold some. I didn't put that much money in. I didn't back myself enough.
No, you're prudent.
Well, yes. And then so I have some lessons here. Then I'll read from my tweet. They say in journalism it's bad policy to quote oneself, but I'll do it anyway because I'm not a journo. I said it's expensive.
It's expensive. When did you post this?
This morning.
Oh.
Because I wanted to talk about it today. It's expensive is still one of the worst investor heuristics in modern investing. That died after nets, which is where you can buy stocks for their cash balance, in the 1970s. And was buried by QE. Like if you're investing in individual stocks and you're worried about things always being expensive, you're doing it wrong. Once you get good at investing in stocks, the tweet goes on to say, you quickly realize that our only competitive advantage is time horizon. This is especially true in Australia where there are only 20 to 40 genuinely amazing value creators. So my lesson, Drew, is obviously the thing is, I don't even know what I did with the other money that I had in Pro Medicus.
Yeah.
Like, I don't even know what I did.
You bought 2 Teslas or
nah, they're horrible investments. But I think
boat?
That's a terrible investment. Every day I look at it and it's under the tarp. I'm like, gee, I should do something about that.
I'll borrow it.
You can borrow it.
Yeah, I won't pay you for it.
Drive it into another boat, see if I can claim an insurance.
I just pulled this up, and maybe this is chart crime, but and this is so constant. Overvalued. It's overvalued. And everyone refers to this, the CAPE ratio, the cyclically adjusted PE ratio. Mm-hmm. I just pulled it up and I didn't know what it would look like. But basically, since 1995, the market's been overvalued all but 3 years post the GFC, like after the market fell 60%. At every other point, it's been overvalued on the context of the Shiller CAPE ratio.
Yeah, well,
yet if you bought at any of those points in time, you've been on 10% returns. Not that they're going to guaranteed to continue in the future. You talk about that a lot, but the returns have been significant and amazing during most of those periods.
Yeah, definitely. It's we had David Gardner on the show. His episode appears soon. He's come out with his new book, Rule Breaker Investing. It's a wonderful book. Like if you're going to read a stock market investing book, like individual stocks, easily one of the best books I've read. It's, for me personally, it's better than the Psychology of Money, Morgan Housel type book because this is my jam. And I think David's probably the best stock picker over the past 30 years in the world. So it was absolutely wonderful to chat to him. The episode will be out soon. But one of his things is, one of his books, Drew, one of his lessons is strong price appreciation. So he's got like 6 criteria. And one of the criteria is look for stocks that have gone up.
Yeah, not head and shoulders.
Not head and shoulders and not 52-week lows.
Yep.
What are the companies that have gone up?
Yep.
And Pro Medicus is one of those companies that has gone up. And I remember people, the most rational thing that people used to say to me, and I was like, I have no flippant answer for that. I don't know how I can come back to you with something logical. But they were like, some of the really good investors at the time when I was holding Pro Medicus, they were like, it only spends $4.5 million a year on R&D. How's it going to compete against Philips? And meanwhile, it just won the Mayo Clinic as a client for its software. And I'm like, I have no idea.
You got to shut. I mean, sometimes you don't want to shut all that out because you need to hear it. So at least test your thesis by listening to that, which you tested yours too much.
But I was like, I don't know.
When you say going up, over what period? Like it's up tomorrow, up yesterday.
So he goes like overall.
Yeah.
So the theory is winners keep on winning.
Yeah.
And he did this wonderful podcast in 2017 with
sounds like Ricky
Patrick Roche. Back in 1996. Pick up sticks. So anyway, that's a Waterboy reference for anyone that's old enough. So he did this podcast in 2017 where he talked about like rule breaker investing, and it was the early days. And Patrick, who's a quantitative specialist, Patrick O'Shaughnessy, talked about how he basically went into this conversation, and in the intro to this podcast, Patrick O'Shaughnessy, who's a quantitative investor, really well known. His dad's incredibly well known. Patrick's podcast, Invest Like the Best, was actually named after his dad's book that he wrote, Invest Like the Best, which talked about quantitative investing. Anyway, coming into the podcast, in the introduction, Patrick says, David Gardner's philosophy is diametrically opposed to my own. Yeah. But you'll come away from this podcast feeling more optimistic, right? And so in the intro, Patrick was like, I'm a quant guy, and literally everything that this guy is doing is total opposite to what I'm doing. But if you listen to the actual lessons in that podcast, what they talk about, and I remember this very distinctly, is here's a guy that's like CFA, super quantitative, rational spreadsheet dude. And then here's a guy that's like a creative English writer that has arguably the best investing track record in the world coming together on this podcast. And David's like, I find stocks with strong price appreciation. And then Patrick's like, statistically, the stocks in the top decile tend to be the most expensive for as long as they exist. So he's gone, David's like, strong price appreciation.
Price go up.
Like, price expensive, price stay expensive. It's crazy how two totally different investors have this totally different way of approaching it.
And they both
ended up in the same spot.
Yeah, exactly.
Like, it's crazy, right? And so
it just tells you markets. Everyone thinks that there's a trading strategy or there's some sort of course or there's some sort of charting you can do and it'll work for everyone. But there's all different approaches can work.
Absolutely. And I've seen that play out with like Pro Medicus. I put in the little tweet thing that I did today.
Although catching falling knives doesn't.
Price to earnings ratio for Pro Medicus hasn't really been below 150 since 2019.
Yeah.
And even then it was still 100. So
I thought you would have put that on a log scale or something.
Probably should have changed the axis. But in terms of like ticker terminal, TIKR, that's
never been below 50 times.
Yeah.
So no one like with any value bent would ever have had a buy on that at any point.
Yeah.
Yeah.
Same with WiseTech, which we'll talk about in a sec.
Yeah.
But and Tesla. So we'll talk just quickly on Pro Medicus. I've been getting a lot of questions about this. Yes, I still own my original shares. Not all of them. I sold some because I had a stupid bias. I was like, have you ever heard of the house money effect?
Yeah.
I took all the money that I invested into Pro Medicus and then kept all the money that was profit.
Yeah. Left that in. Let it roll.
It's called I think it's called the house money effect, where you're just like, it's fake money.
Free money. Let it roll.
Just leave it in there. What an idiot. Anyway, so I did Ticker Terminal, which is the tool that I now use for just basically all my valuation work. I still do spreadsheets and stuff, but predominantly just rely on Ticker. I've put in revenue growth for Pro Medicus for the next couple of years of 27%, 69% operating margins, which is stupid, but that's what it's doing. Price earnings multiple, when I sell in a few years at 150x, the implied total return is 7%.
Yeah.
So what that basically means, to cut down more jargon, is it's around fair value, according to my guesstimates. It's not going to be cheap, but yeah, that's where it's at. I'm very confident there'll be more Pro Medicuses in Australia, so keep looking.
Yeah.
In fact, someone commented in the thread, Pizza Shapes, at Pizza Shapes 2, said this is like where my head is at around Life 360, which trades under the ticker symbol 360. They say it's now expensive, but management keep delivering quarter on quarter. Do I sell quality growth because of a gnarly PE ratio? I am legitimately conflicted about this one. I don't know. Have you ever had a huge winner, Drew? Like 1,000%?
Yeah, I've had a couple.
Yeah.
I've still got them.
Yeah.
They weren't as, 100 grand of my 110 grand savings when I
No.
did them.
But I'm not saying that wasn't 100 grand of my money, but if it was, that's what it would be worth. I did the math the other day. I was like,
I've kind of let them go.
Oh
Though
gosh.
Zip, I did the house money thing, but then the house money almost lost as much as I gained in the first place.
I did that with QB ones.
There's always lessons, but most of them, their position size, they're probably 3-4% of my portfolio. I think, was it Zillow might have been one.
Oh, yeah, I remember you talking about that.
Originally, or Trade Desk might have been.
Yeah, Trade Desk was a big one.
Essentially let them run, which meant that during the tech sell-off, they fell like 60, 70%. SoFi, I think SoFi's sitting pretty well now too.
What the F, Drew? I just realized I passed on Life 360 at about $3. It's now $52.
Yeah. That's crazy for it. Is it tracking software?
Yeah, it's for like safety monitoring, people like kids and that sort of stuff, big in the US.
Yeah.
The reason I didn't invest in it, I was like, Apple's just going to do this.
Yeah.
Apple's going to add this feature. It's now a $12 billion company.
Apple will buy it probably.
$52 a share. Oh my God.
Yeah. It is a challenging valuation.
Oh yeah. I mean,
would you buy it now?
300p ratio. I don't know. I haven't kept up with it because I've read it off. I was like, no, it's not a good business model. And then, oh geez.
You know what's undervalued?
What's that?
Tesla.
Yes. Let's get into Tesla.
According to Cathie Wood.
ARK.
Yeah.
Isn't the valuation, what's the share price now?
Share price was it just over 430?
Okay.
Fell a little bit overnight.
Okay, so $430 plus stimulus check equals valuation. $1,000 stimulus check equals valuation. So why is it undervalued?
Well, Cathie Wood, speaking on the Diary of a CEO podcast, this is but she's not just on the Diary of a CEO podcast, but she talks about this regularly, put a valuation of, it was something exceptional. She thinks a robotaxi business will be 90-something% of Tesla's business in 2029. So she's a massive opportunity. I think her bear case was about USD $2,000.
Yeah.
And her bull case, I think it was, I'm trying to track it down, I lost it, was her expected case in 2029 is 2,600. So that's like what's that, 4, 5, 6 bagger from here. $2,600 per share for Tesla. Undervalued significantly.
And you obviously have it in your portfolio.
I do, but unfortunately it's not going to get 2,600 before the end of this year. It'd be nice if it did.
Yeah. Maybe you got to keep positive, Drew.
And this is that step change. So they ran a Monte Carlo analysis. Their bull case is 3,100. Their bear case is 2,000. So that's still 5 times above where it is. And their expected value is 2,600 by 2029. And this is on the basis that, I was looking at the report today. I've actually never looked that closely at a Tesla report. It's quite like the different stats that they provide, like the installed capacity, how many cars they can produce, where the cars are coming from. Most of it's coming from China now. And the opportunity is that something like energy storage is less than 10% and services are less than 10%. Yeah. And the report was explaining how your car, even if you bought it 10 years ago, is as up to date, if not more up to date than the other cars, because you're just doing software updates that are free.
The only problem with that is full self-driving launches in the next month or two.
Yeah.
And the old hardware they're not going to release straight away. So everyone's suing them in Australia. Which I get.
It's going to take too long.
Because now that we have 2 Teslas at Casa del Rask.
Flock.
Now we have
a flock of Teslas? Array of Teslas.
What's a gaggle? A murder of Teslas. Now that we have a murder of Teslas, we have one of our older Teslas, it's only 3 years old, is not capable of doing the new self-driving.
Yeah.
That it will be eventually, but they're not going to release it
straight away. Like a hardware update, not a software update.
Yeah, and they reckon they could honor the actual go back and update it. But
so the idea is that in 2023, autonomous ride hail, 0% revenue, $0.
Yep.
Up to 603. I'm assuming that's billions.
Yep.
In 2029.
That's what Cathie's forecasting.
Yeah, for ride hail. I have to look at the specifics on, because if all these Teslas turn into autonomous taxis, well, the price of transport is going to fall by like 90%. So I assume they're pricing in a reduction in like Uber rides by 90% because there's so much competition.
Yeah.
You'd have to be the type of model. But that's a step change in this business that I think maybe Tesla shareholders see the opportunity in. Maybe they don't see the same opportunity that Cathie Wood does. But and it'd be similar in Pro Medicus. Like the step change was that it went parabolic basically. Yep. That every hospital wanted this technology, and that was what people couldn't see when the PE was 90 times. And that's what Cathie's seeing. I'm not saying it's going to go there either, but it's clearly, I think, the ability to see something different, whether it was in Apple, whether it was in NVIDIA, whether it was in Amazon, 15, 20 years ago, is where the opportunity comes from.
It's interesting you mentioned Apple. I actually think about this with Tesla. When was the last time that you remember the price increase for your Apple iCloud?
I saw an email today, but I haven't noticed if it's gone up or not.
Exactly.
Yeah.
Right. Now with Tesla, the price in Australia just went up for your internet connectivity. If you want internet connectivity, it went from $9.99 a month to $14.99 a month.
Oh, 50% increase.
50% increase.
Service revenue. That's service revenue? Yeah.
Yeah, I'm guessing so. But imagine it goes from $9.99 a month to $400.99 a month.
Yeah.
What am I going to do?
Yeah.
I'm going to get rid of the Tesla? Like
Tesla's be worthless.
Of course I'm going to pay the money. And Tesla knows this.
You find some way to, maybe you saw Starlink on top of it or something.
Yeah, that's it. Yeah. Sucked in, Elon. But no, so the reality is that the software is, people are obsessing about the number of units that Tesla produces. So the bare thesis on Tesla right now is can't produce enough cars.
It's a car manufacturer.
But the reality is 2 areas of growth. Subscriptions, whether that's robo-taxis, whether it's the features, whether it's whatever, the new self-driving that comes out next month or soon for $149. Or maybe it's the adjacent type products that Tesla is offering. Things like energy, battery storage, robotics, automation. Yeah. Huge part of Tesla's future, arguably. And so with Kathy's thing, I actually think a better way to think about this would be, what does the energy storage side of the business look like? In addition to just selling cars. It's like, if you think Apple is about like the physical metal that is on this phone that I'm holding up, it's not. There's a nice photo of Charlie. It's actually about the software. Yeah. And I think that's what everyone's missing. Like if you jump into your BYD and it looks like a Boeing 737 and you got all these widgets and you're like beep, boop, bop, boop, beep, and you got to take it in at $600 every 6 months to get it serviced. No. It's not the same thing. So I don't own Tesla shares. I did a bit of this quick valuation though.
The good thing is this countering, like you watch a video on Instagram or TikTok that shows, the Tesla didn't see a fake child running out in the road in front of it. But then they counter this through all the data. So probably the Patrick O'Shaughnessy view, which is like the number of miles per crash. It's doing like 6 times more miles per crash than a human driver. Yeah. It's doing better than all the other, like the Waymo, all these other alternatives. So it's always good countering that. And I feel like Tesla's almost like gold, that it's one of those companies that everyone has a view on. Yeah. Because they're so abundant in Victoria for sure, and probably Sydney as well, that everyone has a view.
Well, yeah, Jeremy Clarkson of Top Gun fame, the Clarkson's farm, calls
Top Gear. Not Tom Cruise.
Not Top Gun, sorry, he doesn't fly planes. He probably would though if he was small enough. Very different stature in those two men. Jeremy Clarkson calls them white goods. Yeah. He's like, it's just a white good. So
just replace it. It's got a battery in it.
Tesla. Yep. How much do you expect revenues to grow until 2028? I've done 15% because even if Tesla just keeps the other parts of its business steady, but the software revenue starts to kick in, they're going to charge more. What do you expect operating margins to be? This is the critical input for Tesla. All of the bears, for as long as Tesla's existed, have said that it's just going to be a Toyota. It's going to have no margin because they can't compete. What's their advantage? Yep. So I've said 14% for operating margins.
Which is about where it's been.
PE ratio, it's averaged 150 right now, 140. This is according to the ticker terminal, TIKR. Over the last 5 years, the PE ratio has been 100 times. I've gone 75 times PE ratio, and the valuation comes out at fair value.
It's fair value at the moment. Yeah. Which would lean towards a buy. I mean, 70% of those are buys, aren't they? So it's kind of...
Yeah. Well, I would have, like, I think there's like moonshots embedded in this business. So like there's potential that the robotics business is, imagine paying $25,000 and you've just got like a full-time housekeeper. Yeah. Hey, go scrub the floor. Hey, get me a Coke.
That's not a housekeeper. That's a servant.
The machine, the robotics prime and whatever it's called. Go mow the lawn.
That's another moonshot, and that's where they're investing a fair bit. Not even that much. I mean, only investing something like $4 billion into R&D each quarter. Yeah, which consider the market cap is much.
It's got $35 billion in cash. Yeah,
I think you're probably unders on revenue growth. Like if you think about where this can go in the future, but the other two, it kind of makes sense. Margins stay as they are. Maybe a slight weakening of the multiple, but your revenue could be stronger. Particularly, like the back end might be towards 2029 might be 40%.
True.
The front end might be where it is at the moment, which is falling.
Yep. Yeah, true. That's the big bear case, is the revenue falls because it's outcompeted by BYD. And BYD has done a fantastic job. It's a good business, has great products, no doubt about that.
They've had their own struggles though. They're not just, there was actually an article, wasn't it, that they were actually selling their batteries.
Yeah, they sell
to
the battery.
Nokia back in the 90s or something.
Yeah, they do. Yeah, so they've always done, they're like Cattle, CATL from China as well. It does battery tech and all that sort of stuff. Obviously, China's where a lot of Tesla's revenue is derived in the segment revenue, and that's because they ship a lot of cars from Shanghai.
Yeah.
That's where one of the gigafactories is. Yet another reason why Trump is doing what he's doing around the world is because, well, here's one of the most amazing American companies being built in China.
I think so that bromance disappeared pretty quickly.
Yeah, that did. How's that Chinese growth going? So good business. I would own a small position of it.
Yeah.
Final one.
I've been thinking about buying for a while.
I know we're mindful of time, Drew, but
we've been
just ranting about
babbling
stocks.
on for a while.
WiseTech, buy, hold, sell in your books.
WiseTech, I feel like it's a buy for those willing to accept some risk.
Okay. All right, I'm just going to jump into. I did a very back of the envelope.
I found it because I haven't had a very close look at this company before, and it's going to be volatile, and it has obviously some corporate concerns at the moment, governance concerns. But I was looking at, there's a chart that I put into the notes which shows WiseTech's role in the trade and logistics, like understanding what they do. It's basic, as my understanding is, it's software that means you're not doing a procurement form at one end and then checking that, signing it off, someone else signs it, it gets ripped on the way to the all that. Basically, it's not necessarily automated, and then it helps with cross-border. So we're not visas, but
like trade flow,
dealing with tariffs and understanding where everything is. But they've shown, and obviously it's by WiseTech, so it's obviously tilted towards how important they are in it. But basically, with the purchase of E2 Open, almost every part of the trade logistics process is covered by WiseTech now.
Yeah, it's a wonderful business.
Compliance, domestic warehouse, domestic logistics, international freight, and then domestic logistics on the other side, customs and border compliance. Like it's so integrated that no matter what happens, is your old saying, even a fool,
even a monkey,
even a fool or a monkey can run a good business, but an expert couldn't fix a bad business.
Yeah, it's true.
Prove me wrong.
No, I agree.
This is the hold my beer time, isn't it?
Well, no, I hope it's great because it's got like 90% retention, right?
Yeah. Once it's embedded.
This is the margin that people fail to understand unit economics. It's like if 90% of your business is recurring, every year you wake up and you go to work, you only need to replace 10% of the customers to keep growing. Yeah. Whereas if you've got like a fast-moving business that doesn't have any loyalty or any customer retention, you have to do 100% of what you did last year, plus an extra 20% this year to get 20% growth.
Yeah.
So it's just like Oracle, which we talked about. It's like Apple with the loyalty. It's like Microsoft 365, Pro Medicus with its radiology software. And that's why I think the share price has been cut down recently. It's back to about where I paid it, what I paid for it recently. I also own it. It's basically exactly the same. I also own it via the ATEC ETF. So we own the ATEC ETF at Rask. Good ETF, does technology in Australia. I actually did a quick ticker terminal valuation on this. I called it buy the avocado dip.
I remember this.
20% revenue growth is what I've estimated for the next 3 years.
Okay.
Which is in line with the last 3, 5, 10 years, whatever. Yeah. Operating margin, which is the EBIT margin of 39%. It's historically been 37%. And I was like, well, yes, they've got these acquisitions that they're doing and they're bigger acquisitions and that's probably a risk, but
they've got scalability.
It's got scale. Yeah. It's got scale now. They can optimize more and more. What do you think the PE ratio would be? It's average 80 for the last 15 years. It hasn't been listed that long, but I said 90 when I sell it.
Yeah.
Because the PE ratio is not the important thing with the business and it's 100% undervalued.
Yeah. 100% undervalued.
Yeah.
Yeah.
Yeah. So
what's it done this year? It's
down.
Been a bit rough, hasn't it?
Yeah. The big risks,
minus 32%.
It blows up an acquisition, which has been the fear since day one. And 2 is Richard White kind of eventually moves out of the business.
But you don't get that cheap. Like you don't get cheap without risk.
Yeah.
And that's where, execution risk is pretty high.
Well, think about it. Like how many companies have over 90% retention, are globally diversified, operating in an industry that's worth trillions of dollars, that is probably a market leader that has a founder alignment.
Well, you could say that
How
is
many
an
actually have
infrastructure like business.
It is. How many?
It's greasing the wheels of global trade.
Yeah. But legitimately, like how many businesses actually have that in Australia? I don't even know.
Not many.
There would be 5, maybe?
Not Woolies.
You got, not Woolies. You got WiseTech, Pro Medicus has strong founder ownership. You've got Objective Corp, maybe ARB, you could say with the family, or the Wilson family at Reese.
They're a different level, yeah.
I can't, maybe Life 360.
Yeah.
I don't actually know any other real, Net Wealth with the Heiner family.
It's very domestic. You're talking about a globally facing company.
Yeah, I don't know many. So, like, obviously you got Canva in private markets, but Atlassian maybe. But yeah, anyway, I think it's, if you've got to tilt your portfolio somewhere, you may as well tilt it towards the things that actually are going to make money. So we've got, do you want to quickly go over some of these other things? Anything that jump out to you?
ANZ, a record high. I found this kind of super interesting.
Speaking of great businesses.
Yeah. It could be 3 to 5 years from now.
Well, yeah, it's had
So CBA's had a bit of a struggle, but
super regional policy didn't really work out.
The Asian banks that shut down or sold off.
A bit like NAB's UK Ventures.
Yeah, just always add in a buyback clause when you sell to a big bank from Australia. But shares rallied. New CEO has been sacking and making redundant, like huge pools of redundancy.
Matos.
Maybe in Nuno.
But
now he's basically I think cut back on or cancelled the $800 million share buyback. So it's like, we're trying to cut costs, we're trying to restructure. Why are we buying back shares? They might be cheap, but we need this money. He's already committed to 3,500 to 4,000 jobs, but now he's going to cut a further $800 million in costs, and apparently accelerate the next acquisition, the Suncor acquisition. Who knows how that goes? But then leverage down on business and mortgage bankers, basically. So every bank is targeting business bankers at the business lending as a huge part at the moment, because banks don't really want to lend to construction and do where the private credit market's gone, because they can't lend as much when they do that. So business and mortgage brokers, where they're like, it's just narrowing down and trying to catch up to CBA, basically. Yeah. But the share price at not a record high, but I haven't seen this level since 2015.
Yeah,
10 years it's taken to get back to this level.
$36 thereabouts. It hasn't reached since April 2015.
Yeah.
So 10 years.
We've always held in our direct portfolios 3 banks, not 4.
Yeah.
ANZ was one of them, originally for the super regional strategy. And it's kind of given the kick up for supporting CBA's kind of fall off, and so has NAB, I think, in the last few months as well.
NAB has always been one of my picks for the business. Obviously, CBA is the number one business bank in the country, and you could hold CBA shares still to this day and be fine, but NAB has always been my underdog play in the business banking world.
It feels a bit old.
It does, but to be honest, like for business, it's always been kind of number one.
Even the logo. Maybe, sorry.
What's the ANZ logo meant to be?
I can't. It
looks like a little blue, like a little alien with hands.
Oh, yep.
Anyway.
There's a reason for that.
So NAB, I think, has always had the incumbency in business banking. It's got great relationship bankers. Judo effectively spun out of NAB with all of its staff, and it's proven the model that it can actually work. Interestingly, I'm actually so I'm going to guess you're 3 out of 4 big banks. CBA, ANZ, and NAB. Yeah. And you didn't have Westpac.
No.
Thank goodness, because that is the obvious choice. Reason. What's Westpac done over the last 10 years?
It's been the 3rd worst. There's only 4.
It's also at a 10-year high. In April 2015 is when it was at its... Oh, no, it still hasn't reached that point
I think they both struggled. I worked at the CBA, and they were improving their technology in like 2005. They were investing into it heavily over that period. I think they all struggled with adopting technology and getting technology executed on legacy systems. And ANZ and Westpac were the worst because of how diverse they were and how I don't think they were investing enough into it. And that's why CBA's streets ahead. It's their technology, their options, everything works significantly better at CBA.
Yeah, it's crazy.
I don't even bank with CBA. And it's why Macquarie is winning business from CBA. Because Macquarie is doing what CBA did. Approval's easy, like bank account opening, all these things, security great, all these things Macquarie is doing as CBA was doing 5 to 10 years ago. Yeah, no doubt. It's the problem with, if you've got a mega ship like Westpac or ANZ or NAB or something, and you're trying to catch those other 2 banks, is you've got to invest so aggressively in R&D. Yeah. But then you're also, which tanks profits. Dividend. But then you also got to
do it compliantly.
Yeah.
Westpac was really trying hard to catch up, and it made some mistakes. And that's when they had all the, I don't know if you remember this, Drew, they had all the linkages to child exploitation rings and all that sort of stuff quite a few years ago. And I remember seeing all the news, and it was horrible. Obviously, like they didn't do anything wrong themselves. They just didn't have the compliance oversights to detect money laundering. But I remember thinking at the time, why did this probably happen to them? And it probably happened because they were trying to catch up, and they just couldn't catch up fast enough. And they
put pressure on themselves.
to get back to where the others are. But buy, hold, sell ANZ.
Hold.
Buy, hold, sell CBA.
Buy.
Buy, hold, sell NAB.
Buy.
Buy, hold, sell Westpac.
Sell.
Yeah,
it's a bit of a proxy.
I probably agree with that.
It's like, but if you've got 3 of the 4 banks and you're holding Westpac, CBA, and NAB, I'm not selling it for the You're still very much a proxy for the other ones, if that makes sense.
Yeah.
But as if you're going from cash to all 4, that's
brand new positions. Yeah. Okay. Yeah, I agree with you. All right, cool. Should we answer some questions quickly?
Yes, we can try.
I did promise it, and I just ranted on about stocks.
There's always a lot of questions about those anyway.
If you like the show, you can send this podcast to a friend and be like, sorry in advance. But you could say, hey, go and check out this podcast. They do general financial advice only. And that means we don't take into account your needs, goals, or objectives when you hear something on the show. But we would like it if you speak to a financial planner before you act on the information. So the financial advisor can take into account your needs, goals, or objectives. If the guys on the show recommend stocks or ETFs or something like that, just know that investing involves risk. And if we talk about super funds or something like a financial product, it has a PDS. And then your friend will reply, why did you just give me a disclaimer? And you'll be like, because I know it off by heart now. And secondly, you can say to them, and you can send your questions in via the link in the podcast player. And you select the Australian Investors Podcast, and Drew and I take a run at some of your questions. Give us a funny name. Keep it lighthearted. We are doing events in the new year. So 2026, Drew is going on the road and he doesn't even know it yet.
I'm going to do the end of 2025 too. So
taking his shacket.
Are we going rural? I want to go rural.
Really?
Yeah.
Yeah, just on the farm.
Gippy?
Gippsland?
Yeah.
We did Gippsland a little while ago.
My business partner, yeah. I remember the joke he made at that one, yeah.
Yeah.
Didn't age well.
What are your thoughts on the new range of ETFs Avantis has brought to Australia? ? And this is from Prado at BeachHouse.
Someone's been driving past my house.
Drew owns a Prado, so I'll put this to him.
Yeah. Well, Avantis, I think they only came out a few weeks ago. Haven't been around long, but they're issued by American Century Investments, which I'm sure you've heard of, which is actually quite a massive global investment manager. Mm-hmm. The fund, American Century, was available in Australia.
I remember seeing that.
Yeah. I think it's covered by a few research houses from memory. But the 3, it's quite a small group, and I'm sure if we get this wrong, we'll be contacted by Avantis anyway. They're only offering the 3 ETFs. They're all active ETFs, and they're all reasonably low cost. Mm-hmm. And that suggests they're kind of smart beatery, if that makes sense. So smart beta being the index, so tracking the index. But how do you do better than the index? It could be via factors, or it could be via more frequent trading. But there's an emerging markets equity active ETF, global equity active ETF, and a global small cap value ETF, which is more competition. Like all the small cap is value. It seems a lot of the small cap ETFs are value oriented, or the active ones anyway.
Yeah.
And why I say I haven't looked closely enough, but at a fee of just 30 basis points for an actively managed global, it generally means you're getting probably an enhanced indexed, or as I said, smart beta, which is index-like, but with some trading edges around it, where they're trying to do something a bit different, a bit more in buying more of the companies go up.
Yep.
Buying less of the companies go down.
Well, that makes sense.
Yeah. Or adding something other than market cap weighting to it to generate some outperformance.
Yeah. Well, cool. I haven't actually had a look at them yet because what have I been doing this week? Stuff.
Yeah.
Maybe I should look at it. But no, I'm really I love it when new ETFs come to market. Yeah. So if someone has a view on these Avantis ETFs, please write into us or let us know in the community at community.rask.com.au.
It's always careful to watch out for the rules. Particularly, we both like active in emerging markets, but how active is the EM? Yeah. It might be worth partnering this with something else.
Yeah, we own the EMKT ETF from Van Eck. EMKT is a ticker symbol, Emerging Markets Multi-Factor ETF. And it gets a bit complicated.
Yeah.
So go and have a look at that. But basically, you're asking yourself, do these rules make sense for this market? Now, the fund manager will say they always do. That's why they offered it. But there are some instances where the rules do make sense, some where they don't. Like in Australia, the MVW ETF, also from Van Eck, which is an equal weight ETF, does very well. But if you do an equal weight ETF, say in the United States, it hasn't been as successful.
Yeah.
So
the emerging markets, we believed, overweighting securities, we believe to be trading at lower valuations with higher profitability ratios.
So it's like a quality ETF,
Yeah.
quality plus value. Okay. Dickie White writes in, obviously a play on Richard White from WiseTech. Since Owen's bet, WiseTech's share price has gone backwards. Is he still confident in the company breaking the top 20 and winning the cash? Yeah, that's right. So I do have a bet against Trav from Money of Mine.
I thought it was me and I made another bet.
No, that's coming up. Your platinum move, which out of nowhere is
L1
up.
is surging.
Platinum shares are going to the moon, bro, and it's really annoying me. But
of all the things that keep you up awake at night, it's that one.
I do have a $10,000 bet against Trav from Money of Mine. He said, I can't remember the bet. It was like over 5 years, I said that WiseTech will be in the top 20.
Yeah.
It's already number like 24 or something. I don't know.
Yeah.
But it looks like I'm losing. Do I still own the shares? Yes. I own the shares directly as a shareholder. I also own them as part of the ATEC ETF, which is a recommendation at Rask. Not a recommendation for anyone on the show, just a general gist. Solpats is down 14% in a month.
They're just calling out all your bad calls, aren't
Is
they?
this just some
These are all
profit taking
me.
after the recent? Yeah.
Andrew Dermott asked the question.
Is this just some profit taking after the recent Brickworks merger, or am I missing something else
Why
going on
stock
here?
go down?
I have no idea why it's down 14% in a month, but yes, the Brickworks merger is really important. And as we heard from Rob Milner and Todd Barlow, amazing capital allocators on the show not too long ago. First time they've ever been in a podcast together.
Did you pay divvy?
Not 40%. It's done the merger.
Yeah.
Maybe there's a special dividend release. I'd have to look it up, but I don't know off the top of my head. But you don't buy a company like Solpats in the same way you don't buy like the VAS ETF or IVV or VGS or something like this for a month's return. The underlying drivers are of Solpats, patient capital, diversified portfolio that provides good income that is then reinvested into future assets, both on the private side and the public side. If you take that thesis and run with it, that's why anyone would buy Solpats over the long term. And this is from Sell My Soul, by the way, which is a great one. So I don't have a view against Solpats falling. In fact, if it falls, I'm more inclined to buy it, to be honest. Maybe one more question here. Free the Bird. How often are derivatives used by investors? And are there any ETFs that involve them?
Yeah, good question.
There's a lot of ETFs that use derivatives. And maybe this is coming from
From what level of derivatives?
Yeah, but also maybe from a risk, they're worried about derivatives.
Yeah.
So firstly, what is a derivative? Well, it comes from the Latin word that I don't know.
Derivatave.
Yeah, there we go.
That was not Latin.
But it means to get its value from something else.
To derive.
Yeah. So a derivative in finance lingo means like, say, some contract or something that has a value determined by some other thing.
Yeah.
So say, for example, an options contract on a stock. The contract is the thing that you can buy, and its price is determined by the stock that it's attached to.
Yeah.
So you might say to Drew, "Hey Drew, I'll buy your Tesla shares at $500 a share, and here's a legal agreement that binds me to that." That's an options contract, and it's worth something. For example, if the Tesla share price goes to $600 and your agreement was for $500, there's $100 of value on the table. So the option is worth $100 or thereabouts, give or take decay and a few other things that I won't go into.
And futures, usually they introduce leverage.
Yeah.
So derivatives, futures are the agreement to buy something in the future. It could be a swap or it could be a future with
currency,
interest rates.
Forward.
But generally you're introducing leverage.
Yep.
Why do they get used? In some cases, it could be like Munro is a user of derivatives within their long-short fund.
Monroe being a fund manager that we've had on the show.
This is the first one that comes to mind, Nick Griffin. Yep. But basically, you can use it to short individual stocks
so
if you want to.
Bet things fall.
Yep. Or you can add protection to your portfolio. So you can buy essentially S&P futures or S&P options that will make money if the S&P 500 falls, which gives you protection against the rest of your portfolio.
Yep.
That's how options might be used to, and I can probably do a long episode of explaining this risk. But a lot of managed funds use them to manage their exposure. You've got a big capital gain in a company, and you want to reduce the risk within your market. You might use that to reduce your exposure, but they have to be, I think, long, short, or marketed as using derivatives. And
it does. It says synthetic in the title.
And then in ETFs, it has to be it's only if it's fully synthetic. It has to call it synthetic, though, doesn't it?
Beta shares, crude oil, index, currency hedge, complex ETF. That's what they replaced it with, complex. Yeah. Remember when it does something?
Same as the carbon credits.
Yeah.
Because you can't actively
That's
trade
from Global
these
X, isn't it? Carbon credits?
VanEck. There's a global carbon credits.
ASX
that means all that thing holds is derivatives. They're not holding barrels of oil for you. Like you can see how derivatives work in that case, that you can't go and settle on the barrels of oil and hold them for the ETF. It's very difficult to do that.
Good point.
So you're using options or derivatives to deliver that. So there aren't a lot that are just derivatives, but a lot of them will use derivatives.
It's if they're like those commodities or
to manage their risk within their portfolio.
So the big three users are forward contracts for currency hedging. So like IHVV, HNDQ, the FANG hedged. Yeah. Any fixed income like VBND, they all use currency hedging. So that's a form of derivative. Then there's the next level, which is probably like actual derivatives as the instrument, which is like OOO or the carbon credits one. Yeah. And then there's like using derivatives for profit, which is shorting, going long, short,
leveraging up,
that sort of stuff. Yeah. Now, I don't use any quote unquote derivative profit seeking strategy. Yeah. But obviously have currency hedge positions. Do you have any sort of derivative strategies, like pure derivative strategies in your portfolios at Waddle?
There's one that we've used at different points as a hedge. Like this is a truly alternative, like a hedge fund, which is like a currency hedge, a currency trading fund that uses futures and derivatives basically to hedge risk and to try to generate returns when big shocks happen in the market. So that's the only kind of times you'd use it. And then a few of the funds would have some derivatives within them.
Okay.
And I mean, it's popular because so many retail investors in the US are trading options as opposed to trading stocks. And that's probably where the question comes from, is that for retail investors, you can bet that a stock's going up and get leverage on it without putting, as you said, you were talking about $10,000 or $1,000 return, you put your $1,000 on and get $10,000 of exposure. Yep. Not something we've ever recommended, and not something I think is appropriate for the vast majority of people.
Yeah, I agreed completely. Like,
it's like more like gambling.
Yeah, I don't use it for profit at all. It's interesting though. What happens just for people that think they're wunderkind to investing? You think you're God's gift to investing. Everyone goes through that humility curve over the investing cycle, I would say, particularly the men.
Yeah. Falling knives.
We're doing it right.
We've got some good feedback.
What we tend to do is, while we can't just watch the grass grow, we'll go and trade derivatives and warrants, options, futures, whatever.
Surefire trading strategy.
And once all is said and done, when you look back on your life, you'll think, I paid away about 4 to 5% per annum in derivative trading frictional costs. And the longer you stare at it, the longer you realize that options actually drag on your portfolio. People say they're used for asymmetric profits and stuff. It doesn't work. Buy, hold, sell. Charlie Hunnam.
Oh, Charlie Hunnam from Sons of Anarchy.
Yes.
Buy.
Yeah, definitely.
Yeah, very handsome man.
Oh boy, King Arthur.
Is there a new movie?
Yeah, Monster, the Ed Gein story is really seriously disturbing on Netflix. But if you're into like serial killer type things, he said he had to go away by himself for a week afterwards just to kind of wash his soul of the character. It's on Netflix. It's available now. Yeah. And he speaks in a really funny voice.
Slow Horses, also incredible.
Slow Horses, the new series out now. Episode drops every Wednesday. Check it out.
And just got into Black Rabbit.
Black Rabbit? Interesting. I haven't seen that,
Solid.
Cool. If you want to get in touch with Drew, you can go to the waddlepartners.com.au website.
Shoot me an email.
They're absolutely inundated. It's drew@waddlepartners.com.au. His email address. Just get that out there.
It's free.
Put that in the AI algorithm.
Don't give my phone number.
That's and it's 04. No, what's Jamie's number?
04.
No, but seriously, get in touch with the team at Waddle Partners for retirement planning. If you do want to get anything else you do want to invest with us at Rask, you can head to the link in your podcast player. But otherwise, we don't really mind. We just want to see you next Saturday when you rock up for 2 cents at 7 a.m. So don't forget to subscribe. Drew is going to send us off into the sunset with a dad joke.
I reckon this is a good one too.
Go for it.
Why can't your nose be 12 inches long?
Excuse me?
Because then it would be a foot.
What?
That's the first time I've heard you laugh.
What? Anyway,
That was a killer.
hilarious.
Yeah. Love it.
Well, Drew, absolute pleasure. Thanks for joining me.
Good to see you.
Nice. Thanks for watching this episode of the podcast. If you want to hear more from us, you can get daily videos and podcasts on Rask's YouTube channel. Or if you want to enroll in a free course on investing, property, business, money, you name it, you can join over 34,000 other students and enroll in a free course on the Rask website. Simply head to www.rask.com.au and follow the prompts. Thanks for watching this Rask podcast.